America today stands as the world's largest debtor nation, with a national debt of more than $32 trillion. That number is so large, it's almost impossible to imagine. China follows with 15 trillion, Japan with nearly 11 trillion, while India and Pakistan sit much lower on the list at $3 trillion and $260 billion respectively. But what does this really mean? Is having debt always a bad thing? And how does it affect the lives of ordinary people in these countries? Debt, in simple terms, is the money a government borrows to fund its spending when its income from taxes is not enough. Just like individuals take loans to buy houses or run businesses, nations borrow to build infrastructure, support the economy, or face crises. So, debt is not automatically a curse. In fact, many developed countries rely on it to grow faster. For example, the United States borrows heavily, but uses that money to invest in technology, defense, innovation, and welfare systems that keep the economy strong and people's lives stable. However, when debt becomes too high, it can turn from a tool of progress into a burden. The biggest harm of a rising national debt is inflation and the loss of purchasing power. When a government borrows too much, it often has to print more money to repay interest. That increases the money supply, which makes prices rise. Ordinary people end up paying more for food, housing, and basic needs while their income stays the same. Over time, this reduces the standard of living and makes the cost of survival higher. Another major effect is that governments spend more on paying interest than on public services. In the case of America, billions of dollars from the national budget go just to cover the interest on debt. That means less funding for healthcare, education, and infrastructure. It also limits the ability to respond quickly to emergencies, like recessions or wars. The burden ultimately falls on taxpayers, who carry the weight of past borrowing decisions. For developing countries like India and Pakistan, the impact can be even more serious. India's debt level of around $3 trillion is high, but it's balanced by a growing economy and strong production base. The government borrows to fund infrastructure, digital projects, and social welfare programs. These investments create jobs, raise incomes, and can eventually pay back the loans if managed wisely. So, there is a benefit to using debt as a tool for development when it drives growth and strengthens industries. Pakistan, on the other hand, faces a tougher situation, with debt exceeding $260 billion. Much of it is external and in foreign currencies. This means Pakistan must repay in dollars, which puts pressure on its reserves and currency value. When the rupee weakens, the cost of imports rises, leading to inflation. The average citizen feels this immediately through expensive fuel, electricity, and daily essentials. Moreover, high debt forces the government to borrow more just to pay off previous loans. A vicious cycle that leaves little money for progress. Yet, even in this scenario, there can be limited benefits. Borrowed funds can help a struggling economy stay afloat, pay salaries, and maintain essential services. They can also attract foreign confidence if managed transparently. But these advantages vanish if corruption, mismanagement, or political instability interfere. For people to truly benefit from national debt, governments must ensure borrowed money is invested productively, not wasted. Another hidden harm of large debt is the effect on future generations. The children of today may inherit the tax burden of their parents' borrowing. When governments cannot repay, they often raise taxes or cut subsidies, making life harder for the working class. This can create frustration, social unrest, and a feeling that progress is only for the rich, while the poor bear the cost. Still, it's important to note that debt is not just a sign of weakness. The United States, despite being the largest debtor, remains one of the world's richest nations. Its economy is strong enough to sustain borrowing because investors trust that America will pay back. The US dollar remains the global reserve currency, which gives it a unique advantage. It can borrow at low interest rates and print money without losing global confidence, something developing countries cannot easily do. In contrast, if a country like Pakistan prints money to pay its debt, its currency collapses. That's the difference between economic strength and economic fragility. Debt can be a powerful weapon when used responsibly, but it can destroy stability if misused. For ordinary people, the consequences are real. In a high-debt environment, jobs become uncertain, prices rise, and opportunities shrink. Governments might freeze salaries, delay projects, or cut welfare programs. On the other hand, if debt is invested smartly in education, technology, renewable energy, or industry, it can lead to long-term prosperity. It's all about how wisely a nation manages its borrowing and whether its leaders think beyond short-term politics. So, while America carries the world's largest debt, its people still enjoy a high standard of living because of strong institutions, innovation, and global influence. India's growing economy shows how debt can fuel development if directed into productive sectors. Pakistan's example warns how unmanaged debt and weak policies can hurt ordinary citizens the most. In the end, national debt is neither pure harm nor pure benefit. It is a double-edged sword, powerful in the hands of wise leaders, but dangerous in the hands of careless ones. For people, the outcome depends on how that debt shapes the economy they live in, the currency they earn, and the prices they pay every single day.